This episode of the Disruption Lab is taped in front of a live studio audience. Johnny, you've deployed capital at Deloitte, which is a $20 billion corporate venture operation. You've deployed capital at Stray Dog, which is an independent fund that is a top quartile fund across the US venture. And now you're launching a venture fund that's backed by a $500 million real estate company here in Kansas City. You've seen three different models. You've experienced a variety of capital formation structures. What, in your opinion, is broken in venture capital right now? What isn't working, and what has kind of led you down this path of seeking or a different model?
That's a great question. Yeah. And thanks for having me, Kevin. By the way, this is great. And thanks everybody for joining. Yeah, it's been a great journey. Like what is broken in venture capital? I think that it's just, I think I've noticed the evolution and, especially what we're seeing now. There's more venture funds and private equity funds than we've ever seen before. There's a tremendous amount of capital that's being poured into startups. And I think it makes the environment a lot more competitive. And I think that, when we see what has happened with startups over the past 20 years, it's caused a lot of venture fund managers to come into the space. But then sometimes things don't always work right. And maybe it's because of the portfolio construction, maybe it's because of the strategy that they're employing, or maybe they don't quite have the access. And so there's a lot of ways to structure a venture fund, I think, to be successful. But I think there's also a lot of pitfalls along the way. And I certainly have my own scars from endeavors that we went through, that some things that worked and some things that didn't. But yeah, I think it's the most exciting time, especially with what's going on with AI, with automation, just to be in the space and see what's happening. It's going to be great to see what happens over the next 10 years.
I think when you look at the trends of venture right now, it seems to be bigger checks, bigger funds. You say there's more funds that are being started and more activity. How do you reconcile those two things, where you seem to like a collapsing towards bigger checks and larger funds where most of the capital is getting deployed? Is it a slowdown? Is it a macro market issue? What's going on there?
The way that we look at it, so we've just launched recently in the past 6 months a fund called Worcester Ventures, and it's anchored by Worcester Investments, which has been it's a 20-year real estate platform that's been around here in Kansas City. And so there's a real estate acquisition arm, there's a financial services business, there's some other things that the business has done. But I think that the interesting thing that we're doing is we're going to the very earliest stages. Like, we're investing at pre-seed. We're putting $250,000 to $500,000 in companies. It's usually their first institutional round of capital that they'll take in. And that's a little bit different than I think some of the news headlines that we typically see. We see Startup A is raised $100 million in a pre-seed round and is valued at $750 million. I mean, these are massive sums of capital that are being poured into these startups at an incredibly early rate, at an early stage. But then, and I think the way a lot of these investors are justifying that is that some of these companies are growing at paces that we've never seen before. I think it was OpenAI ChatGPT got to 750,000 users in some, I don't know what the stat is. I think it was under 24 months, just absolutely very impressive. And so on one hand, you have massive amounts of capital, massive amounts of growth, but we're staying pretty disciplined in our approach, because I think even though those grab the headlines, we see it as there's still great companies out there that aren't necessarily always going to come out of Silicon Valley. When you look at the data, there are great companies being built all over the United States. And so we think we're not trying to chase the biggest deals. We're trying to go in and find entrepreneurs and founders that are really obsessed with solving a very specific business problem and helping back them, and hopefully using the platform that we have. So we invest in prop tech, fintech, and the future of work. We hope that our platform that's been built over the past 20 years can really aid them and help us source some really amazing startup opportunities over the next few years.
So, when you look at like the tagline that you guys have, backed by a real operating platform,
Yeah.
walk me through what that means for a founder when they get a check. What's different than maybe when you were at Stray Dog and you were, doing direct investments through thesis-driven fund, deep
Yeah.
mission, conviction against the cause, but now you've got this operating platform, Worcester Investments.
Yeah.
What's that mean? What's the difference there for a founder?
Yeah, great question, Kevin. It's the platform. We really view it as it helps us source the best opportunities that we can. It helps us diligence those opportunities, and then it helps drive value creation with those companies. So for us, before we even invest in a company, it helps us understand. We can go to the business platform and basically say, look, here's a company that has a really interesting prop tech solution around leasing. What are we doing today? What tools are we employing? So it helps us from a sourcing perspective, a diligence perspective. And a lot of these entrepreneurs are attracted to a platform like this because it allows them to come in and maybe test what they have, allows us to open up our workflows, open up our insights and what we might be able to have. And so that's what we try to do. We just try to give founders access to our business to help them understand their business better, maybe test certain ideas, and maybe even become a customer. Like we can become a customer for them. So yeah, I think it's a cool platform, and I would actually equate it to a lot of what's happening in corporate venturing with really large corporates like Deloitte, which is Deloitte Investments is who I was with before. But a lot of times when they go invest in the company or they partner with the company, one single partnership, one single investment is not going to move the needle for a $20 billion company. We're a little bit different. Like we're willing to invest, but we're also like a smaller company. So a pre-seed investment will move the needle for us. So it's kind of, we get a nice bang for our buck, we think, on the venture side.
I want to take a step back. I want to talk a little bit about your progression, and
Yeah.
so maybe the experience
Yeah.
that you've had. So we've talked about, or you mentioned Deloitte. As a CVC, a very large fund, has its own maybe limitations in terms of, either constraints or headwinds associated with that. And then you went from there to Stray Dog. So tell me a little bit about Stray Dog Capital.
Yeah, Stray Dog Capital was born out of a family office here in Kansas City, and the thesis there was that we really wanted to drive towards building a more sustainable food and ag system. And so I spent 7 years as a partner at Stray Dog Capital investing in still early stage businesses, but they were specific in the food and ag industry. So we did some deep tech, we did some biotech, and other things, but it was a traditionally structured venture capital fund. So the capital didn't come from a big corporation. We raised it from outside investors, similar to what we'll do with Worcester Ventures as well. And we ended up deploying 3 funds in total over about a 7-year period while I was there.
What would you say each one of those experiences? So Deloitte, Stray Dog, and now what you're doing with Worcester. What did those teach you kind of along the way? Each one of them.
Yeah, good question. We could be here. We could be here a long time.
We got time, man. We got time. They got food. They got drinks. They're good. They're good.
It's. I think at Deloitte it was great because I got to see the power of an operationally backed venture fund, and it was really the goal that we had there was Deloitte's a big company. We wanted to generate $5 billion in incremental revenue that didn't come from more people, headcount times rate per hour. And so the way that you do that is maybe you invest in some software businesses. So if you have making this up, you have a drone software company that does a really good job at inspecting like pipelines or certain things in the energy sector. Is that a technology that we could acquire or partner, fold that into some of our energy solutions, and plug that in and sell that to some of our channel partners and go to Exxon and go to these. So we looked at all sorts of different things cross industry, and it demonstrated to me the power that you had to really put some of those technologies to work. And it was a nice fit because a lot of those founders and entrepreneurs were able to drive their own businesses through Deloitte as a channel partner to deliver their own products and services. So that was great. I think that was the first lesson I think I saw at Deloitte. At Stray Dog Capital, it was running a traditional fund. And so there's a lot of things that you don't really partake in when you run a corporate venture fund as opposed to a traditionally structured fund. And so you have to raise money from LPs. You communicate with those LPs, those underlying investors in your fund. And so you're doing a lot more while you're also trying to invest. But at Stray Dog, I think it just, over time, I built conviction about what I thought venture investing it took to be successful. I learned some great things, some things we were really great at. There were some lessons learned along the way, but some of the conviction that I came out with out of that 7 years of doing that was I really believed in the power of diversification. So if you look at the data in terms of how many companies do you need to put in a venture capital portfolio to drive success, and it's, there's sort of a spray and pray methodology where you could put, tons and tons of companies in a portfolio. There's some portfolios that are super concentrated, which may only have 15 companies in a portfolio. But if you look at the outcomes and you look at the data, it would suggest that you need to be on the higher end, and the more companies you can put in there, the better, because you increase your chance of getting an outlier, a winner that's going to produce 50x returns and make up for potentially lots of other losses that you have in the portfolio. So things like that, I think conviction around portfolio construction was really important to me. And then maybe just one other thing at Straight Out Capital was, I think I realized the importance of just being a transparent and kind investor. I think I saw more bad actors in the space than I wish I did. And I just think that I had a great time working with founders in a way that felt like we had an honest and strong relationship. And I could just tell it was great. And I think it aided our relationship in terms of helping to drive value creation with them. So I'm passionate about both of those things, about the portfolio construction and the way you structure a fund, but also the way that you work with other people. I think that's important to me personally as well. And so I think I've taken a lot of those things. We're early stages of Worcester Ventures, but I think those are the things I'm going to take with me here.
And I assume you looked at diligence differently. I mean, you talk about Deloitte was looking at maybe integration opportunities, business alignment, some of those things. Did you ever see deals you're like, ooh, that's a good deal, but it doesn't fit? And whereas maybe at Stray Dog, it was more about you're evaluating the company on the merits of, it doesn't have to fit into a story afterwards. It's got to be a good investment.
That's right. Yeah, it's a little bit of a different dynamic, but in both cases, I mean, we would come across deals that I would love, and for sometimes you can't always participate in that because it doesn't quite fit the thesis, but it also gives you an opportunity to share that great deal with other venture investors that might be able to participate and connect that founder, and you kind of hope that the world comes back and rewards you in that same way later on.
Help me out here, Johnny. Help me with founders that hear that from a VC or from, they pitch an investor, they pitch someone, and they hear, we like the deal, but it's not for us. It's rejection to a founder. How do you position that? How should founders think about that? Should their next question be, well, is there anybody else that that you could introduce me to? I mean, how do they follow up on that?
I think that's a one great follow up you can have, but it's probably the worst part of the job that I don't think gets highlighted enough is, if we probably looked at over the past 4 or 5 years, I've probably been on teams that have looked at between 600 and 800 deals every single year, and we've probably done 5 or 7, something like that. So it's like you're having to say no a lot, and that's my least favorite part about the job. But I think that the way that I would say is a beneficial way to look at that is just, as much as you can, try to take the constructive criticism and know that sometimes it's not always about your business, but it's about a fit with a particular fund. And it could be about the thesis, it could be about the stage that your company is in, it could be about particular characteristics that your business has that they need to see something in traction, or there's all sorts of different things that are considered by a venture investor and that you may consider as a founder. You can look at it the other way too. Like there's a lot of reasons maybe that certain VCs are not a good fit for you. So yeah, I would say the outcome of that, if you get a no or a pass or some constructive feedback, I would say take it, and then absolutely ask if there's anybody else they know. What could we have done better? What would have changed in our business? What piece of the business, if it was different, would have led you to take your decision maybe to the next stage or look a little bit deeper? I think all of those are great questions to ask. Yeah.
And if you get asked that question, you're, open to giving that feedback. I mean, I hear from some founders that it's hard sometimes to get the feedback, especially if you've gone through the process and you've gotten all the way to that stage. Where if it's initial screening and it's like, of course, if you've seen that many deals, you're not going to give everybody that level of feedback. But
yeah, for sure. And I think it depends the length of time that we end up going through the diligence process. Like if we spend 3 weeks with the company going back and forth, and we've both done a lot of work on just trying to understand the business and getting on calls and answering questions and pushing data back and forth, I feel like it's appropriate to give a more in-depth response. You also have more to go off of. Whereas if you sort of look at something immediately over the course of a day and you spend a couple hours on it and you end up passing it, it's like, hey, look, sometimes it's just we don't really have enough conviction on this space, or it's just a little too competitive for us to spend any more time on it. But the folks that we do spend considerable amounts of time with, we do try to be more detailed in the response that we give. I sent a couple emails today and tried to be thoughtful and transparent about really the reason that we passed, and I hope that maybe that helps them down the road.
Realistically, has anybody ever come back to the well and got a deal the second time or the third time? Like you've given feedback and somebody's eventually come back and you've made the investment?
It has. We've done that a couple times actually. Yeah.
So take the feedback.
I think so, and it's it's funny. Like sometimes things just don't work out, but then they'll go off and maybe there's a couple things in the traction that spin up, or they get a new customer and they develop the product a little bit more and it changes the game. But that's happened on multiple occasions. Yeah.
So with what you're doing now, it seems like it's this hybrid model between a CVC and kind of the independent straight dog kind of model. You described it as somewhat like a corporate venture fund with the relationship with Ocean Investments and the work that they're doing there. We talk a little bit about the constrained by in a CVC, constrained by the integration, the thesis, the fit. How do you prevent, in your new role with what you've learned, how do you prevent back by, from becoming constrained by? Like, how do you think about that in this model?
You mean becoming constrained just by having an operating platform behind us?
Absolutely. Yeah.
Yeah, it's a good question. So we ran into one challenge recently that we recently invested in a company that was doing, it had a prop tech solution that was driving automation for property management workflows. And we made an investment in this company, and we came across another company that was doing something very, very simple. We loved the first company that we invested in. That was absolutely the right decision. But the second company we looked at, that the team looked at, was very similar in a lot of ways. We still like that team too. We really like their solution. But where some other traditionally structured funds may be able to, we would still entertain multiple deals in that space, but it's a little bit harder, especially just because the timing, because it was one right after the other. That presents a challenge because we want to pull them into our platform. And if you have two competing companies and sort of one division or one team to work with, that's challenging, right? So I think just realistically, I think there's going to be limitations.
Sure.
But we try to work through those, and we were very transparent with the team, and the reason that we passed was because of that. And,
it's timing. Sorry.
It's a lot of it's timing. Yeah, it really is. And it's just kind of the luck of the game and when we came across each of these companies. But, yeah.
So if you haven't heard the name Wooster Investments previously, how many of you, by show of hands, have heard of Hawaiian Bros? Then you've heard of these guys. They were the co-founders and investors in Hawaiian Bros. So that's something that they've got kind of on their resume. If you can, if you will, Johnny, your work at Stray Dog, there are also some brands in there that I think people would recognize that were portcos within the Stray Dog investment portfolio.
We did, we did a large one of our main themes at Stray Dog Capital was the growing sort of alternative protein theme, and so we looked at it was really based off this idea that if you look at protein demand and from here to 2050, we're gonna have to figure out a way to feed everybody, and so I think we had this thesis around, look, we're gonna have to have things that are less expensive, that are more affordable, And so we went down and we invested in Beyond Meat, which was a crazy ride all the way up, and the company's had some recent struggles. But Geltor is a company that we invested in that was making collagen from using a biotechnology sort of approach, and they went from, call it 30 million in post-money valuation to like 390 post-money valuation in a period of like 18 months when we were investors. So just some wild growth. But yeah, it was a great run with Straight Out Capital, and they're still going. They're doing a great job.
Yeah. So, part of the goal of this is for people to put a face and a person, behind a brand and a fund that they might see. You recently or posted on LinkedIn about Carta's data that was showing that earlier fund vintages have us almost no DPI. That they're not returning capital to their LPs. And you said, I think the quote was, "You can't eat IRR." I'm curious, the venture economics, this idea of, is it the attractiveness of the asset class? Is it, what keeps LPs coming back to this this set if the economics, well, first of all, I guess the first question is, do you believe the economics are broken? And what about that is broken? And then what keeps LPs coming back if that's the case?
Yeah, totally. It's a very tough question to answer. And I would say venture is the most volatile asset class, but is also one of the highest performing asset classes. And so I believe
this is why portfolio strategies are important, right?
This is why portfolio strategy is very important. And so I think you really have to take a long-term perspective, and it's not, venture, the timelines are so long, but it goes beyond the timelines of a traditional fund. Our fund is a 10-year fund, and it'll have 2 or 3 potential 1-year extension periods. So we're talking up to 13 years. You could even go beyond that if you wanted to get approval from the underlying investors. And the reason that they're that long is you think we're investing in a company that's pre-seed all the way to IPO. Like, that process is taking so long, over 10 years in many cases. So the fund has to be able to accommodate that. And so we're seeing just the dynamics of that are causing people to think through, like, do we have the right format for venture? But I think the reason, what keeps folks coming back, I think, is particularly the institutional investors, is they do want exposure to private companies. And if you see how long all of the growth of these private companies, particularly right now with all of the Anthropics and everyone, the folks that are getting all that alpha, that are taking part in all that write-up, is people that have access to private markets. If you can only invest in public markets, you're not going to be able to access that. And so I think that's a big part of it. But it'll go through cycles. Like I said, even though there's 10-year cycles in funds, I think you really have to think about it as 20, 30, 40, 50 years over that time. Like, what are your returns going to look like? You're going to have some bad funds, but there's going to be some great funds in there too. But then on the averages, I think that it's just potentially a function of there being so many new managers in. Everybody kind of manages their own way and has a strategy to do things their own way. And I think we're finding out that some things work, some things don't work quite as well.
We're talking about maybe doing jokes up here and throwing a little humor out. I heard somebody at one point in time talk about, we're talking about failure, as a startup, as a founder, those types of things. And, if you hit 3 out of 10 in the major leagues, you're in the Hall of Fame, throughout your career. I think somebody had said at one point in time, if you hit, and if you hit 2 out of 10, you're below the Mendoza line and you're going to get sit down to the minors, right? But in fund management, you hit 2 out of 10 and you get to raise a new fund.
That's right. You're doing fantastic. Usually, if you hit two home runs out of 10, yeah. And so just to maybe provide a little insight into our model, we expect to invest in about 25 companies over the next 3 years, and we think that the majority of returns, 80% or above, just based on data and based on averages that we've seen in the past. So this could happen or not, but will likely be dependent on like 3 or 4 winners, something like that. 3 or 4 companies in the portfolio will drive the majority of returns. So it's a lot different than like a much later stage private equity fund where you may, in an entire fund, you write much larger checks, but you might put those in 5 to 7 companies. If any one company goes downhill in that private equity portfolio, it's gonna be significant to that fund. So it's just a completely different model at the early stage in venture capital.
Now you guys have made, I think, two decisions that when I first met Cameron, I was first learning about the work that you guys are doing. Cameron's around here somewhere. When I first heard about what you guys were doing, there were two things that struck me. One, that you guys are going down into the pre-seed space, which as an operator backed or platform backed or CVC kind of model is unusual to be like pre-seed, to be that early in that category. So tell me a little bit about the thought process behind, you know, the earlier stage and the, you know, the check sizes that you guys are looking to write.
Yeah, well, we're a first time fund, and so that there's just the simplicity that we'll raise $25 million first fund, and just to be able to invest in enough companies, like getting that basket of companies big enough, it's a little easier to do that from a pre-seed perspective. But even beyond that, I would say something that really, when we're thinking through the strategy of how do we want to go about thinking about strategically approaching this fund, the thing with pre-seed is that when you look at the valuation and what companies are valued at the pre-seed stage, you could be looking at something, you know, anywhere from $5 million post-money valuation to, it gets really crazy now, but I think there's an average somewhere in there that's probably around 10 to 12 post-money valuation. It's just it just makes a lot more sense from that perspective, rather than de-risking a company, waiting a little bit longer, and the price that you have to pay when the company now has $2 million in revenue, $5 million in revenue. It's so we felt that the value that you get at the early stage is outsized for the de-risking if that makes sense. We just feel like you get bang for your buck at pre-seed stage.
Yeah, especially with the like you said, first fund, you know, trying to get as many bets out there as you can. It's going to be easier to find those.
And then maybe just one other thing is that I think AI is also changing things. So we're seeing teams. We talked to a founder the other day that his goal is to build $1 billion company that's worth $1 billion with 9 full-time employees, and so we're in this
already been done, right? It's not
out of
the realm of possibility. It's already been done. Yeah.
So we're at a time where entrepreneurs and founders, like, we have so many great tools at our disposal with AI, and it's a new world out there. And so I think we can be more efficient, and they have the capabilities to where they might not have to raise as much money. You can do more with less capital. You can do more with less people. And so that is the pre-seed strategy as well.
I'm curious, it's not on my list of questions, but since you brought it up, AI, you know, this idea that it's creating greater efficiencies, like you said, it's going to maybe increase runways and some of the other things for founders based on those efficiencies and some of the things they can do. Is there also risk there in terms of what model they've deployed, how they've deployed it? You know, is there a moat around, you know, or is there defensibility in using maybe an open platform or some of these other types of things, depending on how they deployed it? How do you guys evaluate? I mean, that's a whole new set of criteria that you have to look at and evaluate now. How are you thinking about that?
Yeah, I would say that we probably look at it from the perspective that maybe instead of focusing on which model and how is it working, how are you doing it technically, I think that we care more about speed, because I think that, and it's speed to distribution. So like a lot of things we look at with founders is in between our conversations, even during our diligence period. So it's sort of like, what's the traction that's being created here? What's the distribution that they're getting? Are they getting pilot customers? Are they growing revenue? That I think is more important to us than sort of the technical side, because I think we're seeing barriers to entry drop on the software development. Like it's so much easier to build things now. And so what's the differentiator? And I think that it's access to customers, it's speed, can be other things too, data.
Yeah. So the stage was one thing. I said there were two things. The other one is, so it's prop tech, fintech, and future of work.
Yes.
Walk me through the thread there, or the why.
Yeah, it's each of the three themes for our fund ties back to a Worcester investments business. And so we have the multifamily acquisitions that the company has done over, I think it's over at this point, $750 million in multifamily real estate acquisition over time. So that's the prop tech. Fintech, there's a financial services firm that lends in the real estate world. And so we have all of these process around debt servicing and things of that nature. So fintech is the second theme that we have. And then future of work really comes from the fact that there's a property management business, which is just very labor intensive, and it involves large workforces. And so we have all of these workflows in the business where we can test sort of more generic technology tools that we might use to look at how we might reframe work over the coming decades. And so that's a pretty general statement, I think, but it could be, any from a software tool that you might utilize for, I don't know, document signing, all the way to maybe robotics solutions that you might employ on property or elsewhere. And so, every theme sort of ties back to one of the platform businesses.
If you ever want to look up a cool story, the story of how they got started, it's run by two brothers now, but the parents, I think, took out a second mortgage to make their first kind of investments and grew this whole thing out of that. It's a pretty fascinating story about what's possible.
It is. And Worcester Investments is run by Joel Worcester, who's just an incredible entrepreneur, and he's all about growth just as much as he probably was in those early days. And so it's been a nice Kansas City story. They came from the West Coast 20 years ago and decided to call Kansas City home.
All right, I just got to pull the thread on the Hawaiian Bros thing, though. How does that happen? Like, when you think about the what they do and what they're doing now with the fund and stuff, it's you're talking about $100 million in revenue, something that grew pretty quickly. How did that happen?
I'll say that Joel's told the story and others have told the story in depth, and so I probably wouldn't do it justice, but in a sense, it was, I think the idea came from a couple of close friends that they had on the West Coast that had a family restaurant that they were closing, and the Worcester brothers here said, hey, if you want to try this out in Kansas City, we'll try a couple locations. And one thing led to another, and so I think they're still remain one of the largest shareholders of the business, and it's one of the fastest growing fast casual chains in the nation. So it's been a nice success story as well.
The reason I want to kind of pull on that thread, and the reason I wanted to ask was that's company building, right? That's different than making an investment. That's how does that inform what you're doing now with this fund and the backed by strategy, the operated by kind of strategy that you guys are looking at?
Yeah, you know what it does? Joel and the rest of the leadership team are so close to the growth. Like this isn't a massive corporation, that has 50,000 employees. Like they're still so close to the action per se. And so I think it's embedded in the culture and the ecosystem of how do we figure out how to grow. They've been through their own challenges and ups and downs with Worcester Investments, and so I just think that they're all about grit and people that can really make things happen. And I think they still bring that every single day, and I think it helps because it helps you identify with founders that are trying to do that as well. And so I think the fact that it's still Worcester Investments is still a founder-led platform. These folks haven't moved on; they're still there, and it creates a nice connection, I think, with founders.
When I had the opportunity to deal with most of the VCs, the institutional investors in Silicon Valley as a corporate that was coming in and they were pitching, I found the ones that, I don't know, at least were more successful were the ones that had an operator background or a founder background versus the ones that just came from, maybe that, financial background of, I understand how the money moves, I understand how the money works, but the founder, the ones who understood the founders and who understood how to operate, those tended to have a different background. And I guess to that point, most prop tech funds today probably haven't invested in a single building, they're investors. Now, how does that change the way you maybe look at a prop tech company, having that experience of managing the real estate, understanding how it works, those types of things?
Yeah.
Do you see the pitch differently than maybe others might?
I hope so. And that's the idea, right? And the idea is like, look, I haven't spent my career in real estate. I've been more in finance and strategy, but we rely on the leaders in that platform, and it's certainly a collaborative effort to. But over time, I think we're going to get very ingrained in the processes, and it's just about bringing those groups together. Yeah.
So you're background experience in evaluating deals. You talked about Stray Dog a little bit. I mean, those are maybe longer term. You talk about deep tech. You talk about some of the spaces that you're in and that you've invested in. Longer investment thesis than maybe some of the companies that maybe are more SaaS based or kind of.
And some of them were, yeah, because they maybe had physical products, or like we invested in two robotics companies that are one of which is building, each robot has like 1,200 different parts, and so like scaling that company is incredibly difficult. So there some longer time frames certainly when you get into like physical products.
So how does that change, how you're gonna like look at deals, or how an investor might look at deals now?
Yeah, I think that it's funny because hard tech is becoming very popular right now, and you're seeing a ton of capital go into that. And so I think there's a specific way that you have to approach it. And I think the market you're serving has to be big enough at the end to justify some larger checks at the very beginning in order to sort of prove that out. So I just think there's a different capital intensity to it, and probably a little bit different timeline. But we'll do both. It just has to make sense in the underwriting, if that makes sense. We'll still go for purely SaaS businesses that are employing AI, and if it makes sense and we find a robotics company that we love that sort of fits into our thesis that we think can do really well, and the market's big enough, and maybe the valuation is beyond what we would normally do, if the market on the back end that they can capture is big enough, that'll work for us. Yeah.
Um, I think one of the things that I enjoyed learning about you when we first talked was you're a Kansas City guy.
Kansas City, yeah, all the way.
All the way, Kansas City guy, born and bred, been here. And so this isn't someone coming in from the outside doing something here. But you're also launching a venture fund, and it's not in New York, it's not in Austin, it's not in San Francisco, it's not on the coast or in one of these other markets. So what does Kansas City offer? And you're not geographically constraining, kind of the portfolio and how you're evaluating deals. But what does Kansas City, add to that opportunity, and maybe what's missing if you're going to start a venture fund here?
Yeah, maybe I'll start with what people would probably say is missing is you're not next door to thousands of startup founders like you might be if you're living in San Francisco or New York or Los Angeles or something like that. The ecosystem is different. So around here, there's fewer investors, and you need investors at every single stage to sort of help take that company. There's advisors, there's concentration of capital to be put to it. So like Silicon Valley is an amazing ecosystem, right? But I think the cool part about being in Kansas City, or maybe even elsewhere across the country, is that over the past decade or more, like we've seen this transformation where companies are being built everywhere, fantastic companies. And so I tend to think that, hey, maybe it gives us a more grounded approach to what we're doing. It goes back to the Warren Buffett thing, and he sort of talked about how he thinks staying in Omaha sort of gave him, some grounded perspective on the investments that he made. And so hopefully there's a little bit of that too, and it suits our style, right? Because we're not chasing the big marquee Silicon Valley deals. We're really, really looking at it at the founder level. And so, I really didn't know if I would be able to do this work or how long I would be able to do this work living in Kansas City, but it's been a nice surprise so far. And it's a grind, it's a hustle, because we try to meet people all over the country, but we're having a blast.
No, it's awesome. That's great. And we're thankful that you're doing it here. If a founder were to approach you, or you were to give a piece of advice, you had referenced this earlier. And I think the phrase, or the way we position it with founders oftentimes, is not all money is good money. And so if you were giving advice to a founder that was looking to take on an investment, how should they think about the design of the capital? How should they think about the source of the capital differently, based on what they're trying to accomplish, those types of things?
Love this question. I would say venture capital is it's like one of many ways to finance a business. And venture capital is used to finance a very particular type of business, one that you probably, based on fund dynamics, you have to take to multi-$100 million to billion plus outcome, right? But when we thinking about founders in general, just people that want to start an endeavor in their own company, regardless of what it would be, a small or medium-sized business, there's a whole spectrum of ways to finance your business, and it could be from anywhere from friends and family to coming up with unique structures. So I would say I would just say a big thing would be like knowing yourself and what type of business you want to start and what's truly feasible. If I have something that's a little more niche, that may not work in a venture sort of mechanism of financing. And so, knowing yourself what type of business that you want to start, and then being creative about how you go about it. It does not have to be venture, and the journeys could be completely different. And a lot of times, you may not be the type of person that wants to have 200 employees and do all this, but it's more attractive to go down another path and maybe own 85% of your business when you ultimately sell it, rather than 12%. So you're right. Not all money is good money, and I think one of the things that people do is they feel like they have to go to venture to do it. There's businesses are financed in all sorts of different ways, but I think it's also important to just know yourself and what journey you personally want to go on, and I think it'll make for a happier sort of business endeavor.
What do they say? The best investor is a paying customer. Right?
Yeah,
That's
that sounds great.
Revenue wins. Revenue wins every single time. So we run a program called Corporate Connections, and one of the things that we do is we ask those companies if they will tell us some of the problems that they're trying to solve, and let us go find, through the network, go find solutions for them and bring them back in. The other thing we do is reverse pitch, this idea of just throw your problems out and see if there are companies that can be created, because sometimes you just got to understand what the problem is from the domain experts. From that perspective, is having this type of platform, is there ever going to be an opportunity where you guys are just going to put out like a specific call on a problem versus a thesis?
It's a good question. I like that idea. So we may have to incorporate that at some point in time. If we get a big enough platform in the prop tech space, maybe we can sort of do call for action and maybe get some, like we talked about, it's getting easier and easier to build these days. So maybe that warrants some sort of event that we could do and get some ideas or get some prototypes, something like that.
Sounds let's talk. Yeah,
let's do it.
No, we did that. We did it years ago at Sprint. We did it, and my favorite one. I always tell the story if you guys have heard this. I apologize, but Mark Donovan from the Chiefs got up there and did a reverse pitch for the Chiefs, which is pretty cool because he was talking about parking and that if you can solve parking for us, we can take you to 31 other teams, and maybe you can solve parking for them too. It's pretty cool, but it's the idea of putting the problem out there from the buyer's perspective. Versus maybe just bring us your ideas in this thesis kind of thing. So anyway, didn't know if that was something that you guys might be thinking about.
We'll start building our list right now.
Perfect. No, we'll love it, and we'll bring it out to the founders, and we'll build some companies around it. Other advice that you give folks when they're raising capital, like when somebody's, especially in this like pre-seed, what are the things? What are the markers that you look for?
I think some of the things that we look for. We look for founders that are really wanting to go the distance, and so it sort of comes back to just like knowing who you are and knowing what you want to do. But like I said, these are long journeys, and we sort of look for people that a lot of times people that you see that end up running these companies like have been through really challenging things in their life, and it is really tough to go the distance. And so we like to see people that feel like they're up for that, but also are obsessed with the problem. I think that's really what ends up mattering, is if you have a connection and you have sort of this, what we call founder market fit, if there's like sort of a reason that you stumbled upon this, like we absolutely love to see that. And then I think, taking too much money or looking at, the logo that you might be able to put on your website from the investor that you took capital from. We even see it recently in some of the acquisitions that have been made. It's just some companies just took way too much money, and it sort of creates problems down the road. So I'd say in a perfect world, you take just enough money to get to the next stage, and then your business gets revalued, and you keep going, and it's better for everybody, including the founders on the cap table. You get to keep as much of your company as you can.
Great advice. Johnny, thanks for being here tonight. Thanks so
much for having me. Thanks guys for coming out. Appreciate it.
Yeah.